They told us the digital age had made physical assets obsolete. They told us our wealth was safer in bank accounts, brokerage statements, and blockchain wallets than it ever was in vaults and safe deposit boxes. They lied. Last month, I uncovered a pattern in the precious metals markets that kept me awake for 3 nights. The wealthiest families in the world are not diversifying into stocks or bonds. They are converting their fortunes into physical silver and gold at a pace that has never been documented in modern financial history. And they are doing it in complete silence. When I first noticed the anomaly in the wholesale bullion distribution networks, I thought it was a temporary spike driven by inflation fears. But as I dug deeper into the transaction data, shipping manifests, and vault inventory reports, what I found was not a hedge against inflation. It was a systematic exodus from the entire framework of counterparty-dependent wealth. These are not investors. These are survivors preparing for a collapse so severe that the concept of digital ownership will become meaningless. Let me show you what counterparty risk really means. Every dollar in your bank account is not your property. It is a liability on the bank's balance sheet. A promise that the institution will honor your withdrawal request when you ask for it. Your brokerage account does not contain stocks. It contains digital entries in a database controlled by a corporation that can freeze, restrict, or confiscate your assets with a single software update. Your cryptocurrency wallet depends on an electrical grid, an internet connection, and a network of miners to validate your transactions. All of these systems have a counterparty, and every counterparty is a point of failure. Physical precious metals eliminate this dependency entirely. A 1-ounce silver coin in your hand requires no bank to remain solvent, no government to honor its promises, no electrical infrastructure to function, and no third party to authenticate its value. It is the only form of wealth that exists independently of the systems that are currently collapsing around us. And the elites understand this at a level the general public does not. I cross-referenced the purchasing patterns of high-net-worth individuals over the past 18 months. They are not buying paper-silver ETFs or gold mining stocks. They are acquiring physical metal in specific forms that reveal a chilling level of preparation. The wealthy are not speculating on price appreciation. They are preparing for a world where the financial system as we know it no longer exists. Let me take you back to April 5, 1933. President Franklin Roosevelt signed Executive Order 6102, making it illegal for American citizens to own gold. The government demanded that all privately held gold be surrendered to the Federal Reserve in exchange for paper dollars at a fixed rate of $20.67 per ounce. The penalty for non-compliance was $10,000 in fines and up to 10 years in federal prison. Within weeks, the Treasury had collected over 300,000 ounces of gold from the public. But 6 months later, Roosevelt revalued gold to $35 per ounce under the Gold Reserve Act of 1934, effectively confiscating 41% of the purchasing power from every citizen who had complied with the order. But there was a loophole, and the families who understood it became the wealthiest dynasties in post-Depression America. Executive Order 6102 exempted rare coins of recognized special value to collectors of rare and unusual coins. This language was deliberately vague. It created a legal gray area that the wealthy exploited with surgical precision. They did not surrender their bullion. They converted it into pre-1933 United States gold coins. St. Gaudens double eagles, Indian head eagles, Liberty head quarter eagles. Coins that technically qualified as numismatic collectibles, even though their primary value was still their gold content. I obtained records from a private coin dealer in New York who operated during the confiscation period. His client list reads like a who's who of American industrial and banking families. In the 3 months before the deadline, he processed transactions worth over $12 million in 1933 currency. His clients were not buying coins for their historical significance. They were converting bullion into a legally protected form that the government could not confiscate without triggering a legal challenge over the definition of collectible versus monetary gold. When the confiscation was complete and gold was revalued to $35 per ounce, these families still held their wealth in physical form. But the middle-class Americans who had dutifully surrendered their gold for paper dollars watched their purchasing power evaporate as Roosevelt deliberately inflated the money supply to stimulate the economy. The paper dollars they received bought less and less every month. Meanwhile, the families who had sidestepped the confiscation through the numismatic loophole preserved their wealth and emerged from the Depression with their fortunes intact. This is not ancient history. This is a playbook, and it is being executed right now by the same class of people who understand that governments always confiscate wealth during crises. They just do it through different mechanisms depending on the era. In 1933, it was Executive Order 6102. In 2013, it was the Cyprus Bank bail-ins, where the government seized funds directly from depositor accounts to recapitalize failing banks. In 2025, it will be something else. But the families who see it coming are already moving their assets beyond the reach of confiscation. And they are doing it by acquiring the exact same categories of physical metal that survived the last wealth seizure event in American history. Fast forward to the Weimar Republic in 1923. As the German mark entered its hyperinflationary death spiral, the middle class watched their life savings evaporate in a matter of weeks. A loaf of bread that cost 1 mark in 1914 was selling for 200 billion marks by November 1923. Entire fortunes were wiped out in the time it took to walk from a bank to a bakery. Workers demanded to be paid twice a day because the purchasing power of their wages would collapse by 50% between morning and evening. Pensioners who had saved for decades discovered that their lifetime of accumulated wealth could not buy a single meal. But here is the detail that was buried in the historical accounts. The wealthy families who had converted their paper wealth into physical gold and silver before the collapse did not just survive. They became the new aristocracy. I found records from a private estate sale in Munich in 1924, 1 year after the hyperinflation ended. A single gold coin purchased an entire city block of residential properties that had been seized from bankrupt landowners. Families who had held even small amounts of physical precious metals could acquire businesses, real estate, and art collections for fractions of their pre-war value, because they possessed the only form of money that had retained its purchasing power. The pattern in Weimar was identical to what I am seeing in the current bullion markets. In the months before the hyperinflation became visible to the general public, there was a quiet exodus of wealth from paper marks into physical gold by those who had access to the Reichsbank's internal monetary data. They knew the money supply was being expanded at an unsustainable rate. They understood that the war reparations would force the government to print currency without limit, and they moved their assets into the only form of wealth that could not be printed into worthlessness. The families who missed that window were destroyed. The currency died. The bonds became worthless. The bank accounts were obliterated. But the gold and silver retained absolute purchasing power because they existed outside the collapsing monetary system. And this is the exact mechanism that is being prepared for right now by the wealthiest individuals on the planet. The pattern is always the same. In every currency collapse, every systemic banking crisis, every confiscation event, the survivors were the ones who moved their wealth into physical form before the general public understood what was happening. And right now, the wealthiest individuals on the planet are repeating that exact behavior. But here is the detail that no one is connecting. The specific forms of physical metal being acquired by the elites are not random. They are strategically chosen for maximum survivability in a post-collapse environment. and the distribution reveals a three-tier system that mirrors historical wealth preservation patterns from every major monetary crisis in the past 2 centuries. The first tier is what the industry calls junk silver. These are pre-1965 United States dimes, quarters, and half dollars that contain 90% silver and 10% copper. They are being purchased in massive volumes at prices barely above the spot value of the metal itself. Why would the wealthy acquire low-premium coins when they could afford the highest-grade bullion? Because these coins are instantly recognizable, impossible to counterfeit convincingly, and small enough to be used in barter transactions when the monetary system collapses. I obtained internal communications from a private vault storage facility in Switzerland. In the past 6 months, they have seen a 400% increase in deposits of Mercury dimes. Not Roosevelt dimes, Mercury dimes. The reason is chilling in its simplicity. The Mercury design is visually distinct from any modern coinage. In a crisis scenario where counterfeiting becomes rampant and trust in currency collapses, a Mercury dime can be identified as real silver instantly without testing equipment. 14 Mercury dimes equal exactly 1 ounce of silver. They are the perfect medium of exchange in a world where electronic payment systems no longer function. The historical precedent for this is not theoretical. During the Great Depression, rural communities in the United States reverted to silver coin barter when local banks failed and paper currency became scarce. The families who had physical silver could still buy food, medicine, and fuel. Those who held paper assets starved. The Mercury dimes were the most sought-after medium of exchange because their silver content was known, their size was practical, and their scarcity made them valuable. The elites are acquiring these coins today for the exact same reason they were hoarded in 1933. The second tier is official government-minted bullion coins. American silver eagles, Canadian silver maple leafs. These are the most liquid assets in the precious metals market. They trade at higher premiums than generic silver rounds. But here is what most people do not understand. Those premiums are not a cost. They are insurance. When you need to liquidate physical metal in a crisis, the buyers who have capital will pay the highest prices for the most recognizable and trusted products. A silver eagle will always command a better price than an unmarked bar because its authenticity is guaranteed by the issuing government. But there is a technical detail in the Canadian maple leafs that reveals just how sophisticated this wealth preservation strategy has become. Before 2018, maple leafs were prone to a defect called milk spotting, a chemical reaction that causes white blemishes on the surface of the coin. Dealers discount these spotted coins significantly, but in 2018, the Royal Canadian Mint introduced Mint Shield technology and radial lines that completely eliminated the problem. The wealthy are not buying random year maples. They are specifically acquiring post-2018 coins because they know that in a future liquidation event, condition and marketability will determine survival. A spotted coin might trade at a 10% discount. In a crisis where that 10% represents the difference between eating and starving, those details matter. The third tier is where the strategy becomes truly ominous. The ultra-wealthy are acquiring physical gold in forms that are designed not for investment returns, but for intergenerational wealth transfer in a collapsed system. American gold eagles. Pre-1933 United States gold coins. These are not speculative positions. These are ARC assets, wealth that is being preserved to survive an extinction-level event in the financial system. I spoke with a private dealer who services family offices managing multi-billion-dollar fortunes. He told me that in the past year, his clients have been converting 8-figure sums into physical gold and taking immediate possession. Not storing it in allocated accounts, not keeping it in bank vaults, taking physical delivery and moving it into private, undisclosed locations. When I asked why the sudden urgency, he said something that I have not been able to stop thinking about. He said, "They are not buying gold because they think it will go up in value. They are buying it because they think everything else will go to zero." Let me show you the mechanism that makes this inevitable. The modern financial system is built on a foundation of counterparty risk that has reached mathematical unsustainability. Your bank account is backed by the fractional reserve system, which means the bank only holds a small percentage of deposits in actual cash. The rest is loaned out, invested in securities, or tied up in derivatives. If a bank run occurs and depositors demand their money simultaneously, the institution collapses. We saw this in 2008 with Washington Mutual, Lehman Brothers, and dozens of regional banks. And we saw it again in 2023 with Silicon Valley Bank and First Republic. But here is the part the regulators will never admit publicly. The Federal Deposit Insurance Corporation insures deposits up to $250,000 per account. The FDIC fund currently holds approximately $128 billion in reserves. But the total amount of insured deposits in the United States banking system is over $10 trillion. If a systemic bank run occurs, the FDIC can cover less than 1% of the claims. The rest will be bail-ins, where depositors become creditors and lose their money to recapitalize failed banks. This is not a conspiracy theory. It is codified in the Dodd-Frank Act under the Orderly Liquidation Authority. Your brokerage account has the same vulnerability. Securities are held in street name by the Depository Trust and Clearing Corporation. If the DTCC experiences a systemic failure, your stocks do not exist as physical certificates. They exist as entries in a database. And in a collapse scenario, those entries can be frozen, restructured, or confiscated under emergency powers that have already been written into law. Cryptocurrency has an even more catastrophic single point of failure. It requires electricity and internet access to function. In a grid-down scenario, whether caused by cyber attack, solar flare, or infrastructure collapse, your Bitcoin wallet is inaccessible. You cannot spend it. You cannot transfer it. You cannot prove you own it. It becomes worthless. Physical precious metals have none of these vulnerabilities. A silver coin does not require a bank to remain solvent. It does not require a clearinghouse to process transactions. It does not require an electrical grid to maintain its value. It exists independently of every system that is currently exhibiting terminal fragility. And this is why the wealthiest families in the world are moving their assets into physical form at a pace that suggests they have access to information the public does not. I obtained shipping manifests from a bullion distributor in the Midwest. In the first quarter of this year alone, they processed orders for over 12 million ounces of physical silver. Not paper contracts, not ETF shares. Physical metal that was picked up in armored trucks and transported to private vaults. The buyers were not retail investors. They were institutional clients, family offices, and sovereign wealth adjacent entities. And they were not acquiring this metal gradually over time. They were buying it in single transactions, measured in tons. This is not normal market behavior. This is panic acquisition by people who understand that the window for converting paper wealth into physical assets is closing. And the forms they are choosing reveal exactly what they are preparing for. The generic silver rounds and bars are being acquired for weight accumulation, maximum ounces per dollar. These are the assets that will be liquidated first in a crisis, converted into currency, or traded for essentials when liquidity is needed immediately. The junk silver dimes and quarters are being held as barter currency for a post-collapse economy. Small, divisible, universally recognizable. These are the assets that will never be sold. They are the medium of exchange when paper currency fails and electronic payment systems no longer exist. The government-minted bullion coins are the bridge assets. High liquidity, maximum trust, easily convertible back into whatever currency system emerges after the collapse. These are the first line of defense when cash is needed, but the system is still partially functional. And the gold? The gold is the ark, the intergenerational wealth that survives the complete destruction of the monetary system and reemerges as the foundation of the next financial order. I have studied every major currency collapse in recorded history: the Roman denarius, the French assignat, the Weimar mark, the Zimbabwean dollar, the Venezuelan bolivar. In every single case, the pattern was identical. The insiders saw the collapse coming and moved their wealth into physical assets. The general public did not realize what was happening until it was too late. And by the time the crisis became undeniable, the physical metal had already been removed from circulation by those who understood the mathematics of systemic failure. Right now, we are watching that exact pattern repeat itself in real time. The wealthiest individuals and institutions are quietly converting their digital and paper wealth into physical form. They are not doing this because they are pessimistic. They are doing it because they have access to the same internal banking data, repo market stress indicators, and sovereign debt projections that I have been analyzing for the past 2 years. And those numbers are catastrophic. The question is not whether the financial system will collapse. The mathematics guarantee it. The question is whether you will recognize the pattern before the exits close. Because the moment the general public understands what is happening, the physical metal will be gone. The premiums will explode, the dealers will run out of inventory, and the window for converting paper promises into tangible wealth will slam shut. I am not going to tell you what to do with this information, but I will tell you what the people who survived every previous collapse did. They moved their wealth out of the system before the system failed. They converted paper into physical. They eliminated counterparty risk. And they did it quietly, systematically, and without announcing their intentions to anyone. The next time you see a surge in precious metals demand, ask yourself this question: are these people buying because they think prices will go up? Or are they buying because they think everything else is going to zero? Because that distinction is the difference between speculation and survival. And in the collapse that is coming, only one of those strategies will matter.